As we know, doing trading can be quite challenging, especially if what we want to do is scalping, because as we know, at the lower the time frame, more manipulations and more noise we can find in the charts, and if we want to trade with price action, it can be even more difficult. And this is why I want to share with you an indicator and two ways to use it to be able to take all this noise out and be able to see exactly where price can go. And this indicator works with the market structure. As you know, market structure works in this way. It makes lows, highs, lows, highs, lows, highs. But a lot of times we can see things like this, and it starts going like that. It comes back down, goes up, goes down. And obviously these are small manipulations. That obviously is going to make our trading go worse. And this is where this indicator is going to kick in and give us a clearer view of the chart. So if we come to the chart, you'll be able to see basically what I've said. We can see random lows like this one here, right here. It breaks down here, then it comes here, it comes back up here, goes here. And obviously identifying the market structure, if you're not used to it, can be quite difficult. And this is where this indicator that is called ZigZag kicks in. And as we can see, it clears out a lot of the noise of the chart, as we can see. But if we want to make it even more precise, we can change the settings from 15 to 6. And this will make it even more precise to the actual movement of the price. And it will help us see a lot clearer where price can go. But the most important thing is, how can we take advantage of knowing the market structure levels? Well, basically there's two ways of trading this. First one is basically trading with the trend. Okay, so if we have this move here, as we can see up above here, what we're going to aim is to go for the Fibonacci levels on the retracement that normally ends from the 50% to the 78%. So if we actually look at the chart, we can see we've got a new high here and we've got a new low here. It's very important to know that obviously if to make an impulse valid, it firstly has to make either a new high or it has to make a new low of the previous high or low. If it doesn't do this, then it won't be a valid impulse. So in this case, we can see that our recent low was here, this was a recent high, and the price, we can see we had an internal retracement, and well, they call this a complex retracement. And after that, it made a new high. Once it's made this new high, this becomes the new low and the new high. And here is we can trace our Fibonacci levels, tracing it from the low up back to the high. As we can see, it retraced on the 78 level. It nearly reached the stop loss, and after that it went back up again. Obviously it didn't reach the new high again, and this is where our trading plan has got to say either we keep the position running or we leave the position with a risk reward of 1 to 2 or 1 to 1 or 1 to 3. Okay, but obviously you need to back test all this to see which is the best for you. The second way of using the market structure is by using the break of the market structure. Okay, so as we know, market structure is doing an uptrend. When it breaks down, we can see a market structure shift here, and what we'll be aiming is to go in now in the short position. So we'll be entering literally the short position round here, putting the stop loss above here, and aiming for the next market structure level break. So when it goes like that and it breaks up again, we'll be exiting the position on this place here. So if we bring that to the actual chart, we can see how we made a new low, a new high, and once this low got broke, we'll be entering the short position right out here. We'll be putting the stop loss at the top of the recent high, and we were aiming for a next market structure level shift. That if we have a look here, we have the new low, we have a small retracement, have another retracement, and this one makes a new low. So this becomes the most recent higher low. Once this gets broken, we will be exiting the position. Obviously, like I say, this must be back tested as well to see what suits you for the best. But for me personally, what I always do is go with the higher time frame trend to do this. So like I say, if we are in an hourly uptrend, okay, this is in the hour time frame, in 5 minutes we'll be looking something like this, okay, because we'll see all the time little market structure breaks. And what we are going to enter is on these levels down here, because we're going to go with the 1 hour time frame, because obviously the higher the time frame, the more confidence we can have in the actual trend. And in the 5 minute chart, we can find always good positions to enter, and by doing this we could even increase the risk reward, because if we're entering on this point here, we have a smaller stop loss, because the stop loss will be down here, and we'll be aiming for like the big targets, and this would give us even risk rewards from like 1 to 5, 1 to 6, 1 to 7. Me personally, I always try to aim for 1 to 2, 1 to 3, because I don't like to have a low win rate, but this depends on each person. And like I say, this has got to be back tested by yourself, because remember that I'm not a financial advisor. This is not a financial advice, and it's just my way of doing scalping on cryptocurrencies.